the event of October was a big deal. And now we have no retail buying because the chart's horrible. And until the chart's positive, macro funds that trade it and retail is not going to be involved. So you need that to turn positive. That's the 92,000 thing. And that number matters more than just the technical thing. It's also unchanged for the year. So I think once we get back above it, I think it's an important thing. But I really do believe that the catalyst that's going to take this up, Bill Gurley said, there are no dollars for anything on the VC world except AI. That has hurt Bitcoin this year because not getting dollars mean people don't view it as a growth trade. They don't view it as something the way they did. The last time we had a SaaS move, crypto was a major part of it. Crypto isn't getting money because it's all being sucked out by AI. I think that starts to change this year.
Markets don't move on narratives alone. They move on capital, positioning, and incentives. And one of the biggest mistakes investors make in every cycle is assuming that a structurally bullish story automatically translates into price action. Bitcoin, despite entering the year after its much-anticipated halving, has been a clear example of that disconnect. Expectations were high, the fundamental supply story was well understood, yet price action has been underwhelming relative to prior post-halving cycles. According to Jordi Visser, a 30-year market veteran and one of the more disciplined macro thinkers in the space, the reason for Bitcoin's slow performance this cycle isn't a lack of conviction, nor is it a failure of the asset itself. It's liquidity. But not liquidity in the way most people frame it. Jordi argues that the limited liquidity in global markets hasn't disappeared. It's been aggressively redirected. And almost all of it has been absorbed by one dominant theme: artificial intelligence. As Jordi explains, capital today is behaving differently. Venture dollars, growth allocations, and speculative flows that once rotated into crypto are now being overwhelmingly funneled into AI. That shift has changed how Bitcoin is perceived, not as a high-growth trade, but as something temporarily sidelined while investors chase the most obvious return profile. Until that capital rotation changes, Jordi believes Bitcoin's price action will remain constrained, regardless of how strong the long-term thesis may be. In this video, we're going to break down Jordi Visser's full framework, from why Bitcoin stalled despite the halving, to how macro conditions, Federal Reserve policy, and AI-driven disruption are reshaping markets in ways most investors still underestimate. If you find value in grounded, forward-looking analysis like this, make sure to like the video, subscribe to the channel, and stay with us through the end, because Jordi's most important insights are still ahead. Thanks, and enjoy the video.
What did you take away from the CPI measurement?
The most important takeaway, in my opinion, for everyone who's listening to this is to care less about whether the number should have been year over year 2.6, 2.7, 2.8, and to go back to what Jerome Powell just said. His focus is on the labor market. His focus on the belief that the bigger risk is the labor market, and we can kind of look through the inflation because going forward, the bigger risk is on the labor side. We got jobs numbers as well. So when you combine the two, makes the Fed's decision look rational. And the reason the inflation stuff, I'll keep saying, we will not have inflation of any magnitude that impacts the market. Could we see CPI above 3% next year? Yes, but gas at the pump is going to have to go higher. So right now you have this I would say if you gave me the top three choices for inflation that matters in terms of the prints, you're going to tell me what gas in the pump has done. People should go look. It's at 4-year lows right now. It's just coming down, and it's coming down relentlessly.
I think it's 38 states. It's under $3.
Yeah. So you're getting this, and this has really fallen sharply over the course of the last few months. At the same point, wages continue to go down, and at the bottom end, they're going even further down. If you don't have wages going higher, it's really hard to make the argument that inflation is going to be sticky when people are voting socialist and they're complaining about the fact they can't afford things. So you have that. And then we've got a polarizing thing of blaming what affordability means and who's on it. Housing is coming down. So owner's equivalent rent straight down, gas at the pump straight down, and wages down. And the inflation swaps, which are the market's expectation of inflation going forward, they're also at the lows of the year and in a diamond ski slope down. So I think people should focus on the fact that there's a higher probability after this week that the Fed's going to raise rates next year. And I think that's where it should be. This becomes important as people still continue to focus on, oh my God, long-term yields are going up in Japan. They're going up in Germany. And I think people are going to have to start to face the facts that we have a steepening yield curve. The inflation data this week, regardless of whether you believe it or not, you have to leave inflation alone now for the next 6 months because the labor market remains the focus.
Do you have a sense for what's driving this kind of deflationary or disinflationary aspect of the economy?
Well, let's start with before I get into kind of a driving force, let's just start with mean reversion, first of all, meaning we had a massive monetary stimulus that took us out of a world where we had been in disinflation for a long time. That disinflation occurred during exponential innovation, which was seen in the form of mobile, the cloud, software, SaaS. Everything that was coming in was disinflationary. We shoved a bunch of money in the system. Think of it as it's the holiday season. People went out. They had too much to drink. Okay. The inflation hangover lasted a while. We're still mean reverting back. That's the first thing. The second thing is if we have a K-shaped economy and if the top end of the wealth is owned by very few people, that means the average person, the median voter in this country, does not have the money to go spend at a restaurant the way they used to, does not have the money. So if you believe in Michael Green's paper and you believe in the poverty thing, whatever your beliefs are, at some point, that means that there isn't enough money to YOLO it and just go do what you want. So I think that's had an impact. But the third thing, and probably the most important, is AI. AI is the force behind disrupting the labor market, putting a cap on wages. There's a reason why Michigan consumer confidence is near all-time lows when back in before the dot-com bubble, it was at all-time highs. New orders for the for PMIs are below 50. Back before the dot-com bubble, they were up above 60. You have a very different world right now in terms of the disruption that's happening from artificial intelligence. The reason I spend so much time going through this, it will remain this disinflationary force. But more importantly, next year is something that you've said something on this podcast that I very seldom hear people say. But the reality is we're going to hire lots of people lots of employees next year, but they're all going to be digital. Mm-hmm. And so if we're hiring digital employees, they're not spending. And if they're not spending, that means the people that are actually at jobs have their wages capped. So I think the artificial intelligence side next year with the agentic stuff starting is going to be an issue. And then 3 years from now, we start getting into the AGI deflationary forces. Inflation, in my opinion, will not be a story again for the markets that matters, and people that focus on it and get all like buggy-eyed over it. It's going to be a big mistake when you're staring at the most deflationary force the world has ever seen. So we've seen a rotation in the market that started in June, and it's kind of accelerated, and that's been out of growth and into more value-related things. It's been out of momentum. It's been into small caps, out of large caps. Those are traditionally kind of the rotations that happen when PMIs start to go higher, which I've talked about, and it hasn't started yet, but I think it's not only going to start next year, but I think it's going to keep going. So the question of what do I expect? I expect the forgotten misfits of the market to outperform the very crowded leaders. And I think this rotation has been happening. I think it's going to be much harder to make money in AI infrastructure names that dominated during the LLM period. And people need to start shifting their attention towards the VLM period, the visual language models. Tesla, hated by most people. I think it's going to be the best performing Mag 7 stock. I still think NVIDIA will do great. I think Apple will do great. Those are all because those are going to start benefiting from brains and machines. NVIDIA will just keep doing well because people are actually bearish it and going through it. I don't like the hyperscalers and anything built on code next year as like a general theme. Now, here are the risks. If I had to pick two things that could be the thing to cause a 20% correction, which I think has a reasonable probability of occurring next year, it would be, first of all, the rotation that's happening. If I'm right and PMIs are heading up towards 60, this would be the first. And I want to make sure people understand this because whenever I say PMIs, people kind of glaze over. We haven't had a build out on the manufacturing side since 2003 to 2007 that's been synchronized around the globe and has been driven by multiple things happening at the same time. We've had inventory rebuilds where because people got really scared, they stopped buying things, thinking a recession was coming. Think about the European situation when we thought Brexit, where we thought Greece and everybody was going under. Take the oil situation in 2015, 2016. Take COVID. In all of those cases, we stopped buying things for a period of time. It was like a mini recession. And then we got this rebuild, which was only to rebuild inventories where it petered out. But we haven't seen anything that has been on a big scale. We're going to have the data center build out.
In the first part of this discussion, Jordi shifts the focus away from headline inflation numbers and toward what he believes truly matters for markets right now, the labor market. He points to a broad disinflationary backdrop: falling gas prices, easing housing costs, declining wage momentum, and inflation expectations trending lower. In Jordi's view, this combination makes sustained, market-impacting inflation unlikely. The bigger risk, he argues, isn't overheating. It's economic disruption beneath the surface. And this is where Jordi's analysis becomes especially forward-looking. He connects disinflation not just to monetary policy or post-pandemic normalization, but to a far more powerful structural force: artificial intelligence. AI, in his framework, isn't just a productivity tool. It's a deflationary engine that caps wages, reshapes labor demand, and fundamentally alters how growth shows up in economic data. Because if AI is suppressing traditional inflation while simultaneously forcing massive infrastructure investment, data centers, power generation, hardware upgrades, then markets are heading into a very different regime than most investors are positioned for. And that's exactly what Jordi unpacks in these next clips.
But now we're going to get into the agentic world. Now we're going to get into the embodied AI world. People need to start understanding what this means. We're going to have a synchronized upgrade for computers, for phones, for autos. We're going to continue to have the data center build out. We're going to need to build nuclear plants. We're going to need to go out and mine for material. This is going to be a PMI going higher. We'll keep saying that. But the risk is, if the Mag 7 or the Mag 4 that I'm saying, if the hyperscalers don't do well and they just kind of go sideways this year, alpha still needs to be created in hedge funds and passive investment. Everyone's going to start rotating into what's working. That could become very disruptive because it could leave people in a position where they need to buy illiquid things and get out of liquid things. Very easy to get out of the liquid things. We've seen how Bitcoin, you can get out of that if you want, no problem. But we haven't seen when people want to go buy small caps, what that actually does. So I think when PMIs are actually going this way, it could be a negative. The second thing, and this just gets back into it, I don't think it's going to be an AI bubble thing. In fact, that's another consensus for the people on the negative side. I guess if I was going to pick something and go through, it's the bottleneck side, that the bottlenecks from the power get worse and that the GDP doesn't actually come through because we're at a standstill with rolling out Blackwell and getting these data centers up and running. I don't think that's going to happen, but that would be another thing. Both scenarios hit the hyperscalers relative to the other names. And that's why I think growth is going to underperform value and size is going to be shifting too.
I want to talk about Bitcoin real quick.
There's three components of Bitcoin that I've kind of put my side on. When is this going to go back up? Because the one thing I believe in is that it's going higher. The question and the point you made, what's the probability it go? What would have to happen for it to sell off past 80,000 and down to 60? Well, number one, the chart is horrible. Okay. There is no way. I've said repeatedly, I'll keep saying it, until you close 3 days in a row above 92,000, I think the downtrend is in place and you have to be very careful that it could extend further than what you believe. What would make it extend? Well, the equity market needs to get worse. I don't think that's going to happen, but like I said, there is a risk to me that growth is going to underperform value. If that happens, which I don't think the market's going to go down, because when you have PMIs going higher, the big risk is that rate hike fears start to enter the market. Like I said, we have disinflation at this point. This looks like the beginning of a reflation stage, which is very good for markets generally. So I think it's a good year for stocks. But if for some reason the rotation dropped down the hyperscalers, because in the next earning reports, they actually show some risk, Bitcoin could sell off. I don't think that's going to happen. And on a probabilistic basis, a move down below 80 for any significant amount of time to me is a low probability event. The technical side is still bearish. The good side for me, again, I wrote the paper about a silent IPO. I still believe that's going on. I get multiple, and I'm sure you do too. Novogratz spoke on something this week, and I like listening to Mike because he has a lot of insight on what's happening because he controls a lot of the flow. And he said, 30% or approximately 20 to 30% of all market makers went out of business from that fall off in October. Whether or not the number is right or not, I'm just going to take Mike for his word and just say the event of October was a big deal. And now we have no retail buying because the chart's horrible. And until the chart's positive, macro funds that trade it and retail is not going to be involved. So you need that to turn positive. That's the 92,000 thing. And that number matters more than just the technical thing. It's also unchanged for the year. So I think once we get back above it, I think it's an important thing. But I really do believe that the catalyst that's going to take this up, Bill Gurley said, there are no dollars for anything on the VC world except AI. That has hurt Bitcoin this year because not getting dollars mean people don't view it as a growth trade. They don't view it as something the way they did. The last time we had a SaaS move, crypto was a major part of it. Crypto isn't getting money because it's all being sucked out by AI. I think that starts to change this year.
In the second half of his analysis, Jordi Visser zooms out and reframes what the next phase of this cycle actually looks like. He doesn't see AI as a speculative bubble, but as a catalyst for one of the largest synchronized investment waves in decades. Data centers, nuclear energy, mining, autos, devices, and embodied AI systems all point toward a global manufacturing and infrastructure rebuild. That's why he expects PMIs to move higher, and why he believes value, size, and overlooked segments of the market will increasingly outperform crowded growth trades. But here's where this becomes critical for crypto. Jordi acknowledges that Bitcoin's technical structure remains fragile in the short term, particularly below key levels that keep retail and macro funds sidelined. However, he's equally clear that the forces suppressing Bitcoin today are not permanent. The same AI-driven capital concentration that hurt crypto is also finite. Once returns compress, bottlenecks emerge, and the rotation broadens, liquidity doesn't disappear, it moves. From that perspective, Bitcoin begins to look less like a failed trade and more like a delayed one. Institutional adoption continues quietly, market structure is improving, supply dynamics remain intact. And if Jordi is right that inflation will not be the dominant macro story, while reflation and capital rotation take over, then the conditions for crypto to reassert itself improve materially. In other words, this cycle isn't broken, it's just been rerouted. And when liquidity finally shifts away from its narrow focus, Bitcoin and the broader crypto market stand to benefit disproportionately. That's why Jordi remains constructive, probabilistic, and patient, traits that tend to matter most when markets feel frustrating and unclear. If this breakdown helped sharpen your view of where markets are heading, make sure to like the video, subscribe for more high-level macro and crypto analysis, and drop a comment below with your thoughts on AI, liquidity, and Bitcoin's next move. Thanks for watching, and we'll see you in the next one.